We are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases.
Let me give you a quick rundown of what's going on and what this means for us as growth-oriented investors who follow ARK Invest and the Metaverse Index and so on. Then I'll tell you exactly what I'm watching out for and what I'm going to buy moving forward. Your time is valuable, so here's a quick summary up front. The Federal Reserve is stopping the money printer completely over the next 4 months and is now expecting to raise interest rates several times over the next few years. Research shows that this could be even worse for growth stocks than many people expect. Either way, in the short and medium term, growth stocks are going to keep going down in price because they just got riskier. And since they just got riskier, I'm going to diversify the holdings inside my portfolio and my assets outside of it. If you've got places to be, that's the high-level overview. For those of you sticking around, let's get into the details. As Jerome Powell said in that clip, the Federal Reserve has 2 goals: maximize employment and keep prices stable. Right now, inflation is near a 30-year high. So, while lowering interest rates and quantitative easing helped with maximum employment, it also caused prices to rise. A lot. If you don't know what quantitative easing is, it's actually where the Federal Reserve increases the money supply by buying bonds on the open market to encourage borrowing and investing. So, when you hear big news channels talking about tapering or the winding down of pandemic support, that's the Federal Reserve slowing down how many bonds they're buying until they're no longer buying any bonds at all. They expect that to happen around March of next year. Once that money printing hits zero, the Federal Reserve can begin raising the federal funds rate, which is also called the overnight lending rate. The federal funds rate is the interest rate that banks charge each other when they borrow money, which in turn determines the short-term interest rates that banks and other lenders charge companies and individuals to borrow that money from them. Here's the issue. Back in September, most Federal Reserve officials agreed that this federal funds rate would stay at under 0.5% through the end of next year, and at around 1% by the end of 2023. As of this last Fed meeting, which was held on December 15th, those estimates essentially doubled to roughly a 1% federal funds rate by the end of 2022, and as high as a 2% or more federal funds rate by the end of 2023. We should also consider the possibility that the Fed could decide to raise this rate even higher if inflation data pushes them in that direction. For example, Goldman Sachs Global Investment Research expects the overnight lending rate to rise even faster through 2024 and reach over 2.5% in 2025. So according to them, the market needs to price in even more pain for growth stocks than it already has been. Let's stay on topic for now, and I'll cover this when I talk about the stocks that I'm watching. Rising interest rates are bad for growth companies because it now costs them more to borrow money, which they'll sometimes do to reinvest into their own growth. It's even worse for young fintech companies who are trying to acquire new customers as cheaply as possible, since they now have to charge those customers more money for loans and lines of credit, which could slow their overall growth. Yet another issue is that when interest rates rise, bond prices fall, making them much more attractive investments. When bonds get cheaper, risky growth stocks look riskier, since they now have to provide an even bigger return to outperform those bonds. So these rising interest rates can be a real triple whammy for growth stocks, which is why ARK Invest's funds are so sensitive to them and why they've been underperforming the market all year. As a result, I expect 2 things to happen. First, I expect growth stocks to keep going down for a while. I know, you're shocked. The other thing I expect is that they'll also get more volatile, which will cause a lot of investors to panic sell stocks that they don't have high conviction in. Just look at Tesla, which is ARK Invest's #1 holding. Maybe it's yours as well. Yes, Tesla is down by over 20% in the last couple of months, but look at how it got there. Volatility is way up because the market literally cannot agree on Tesla's value. Is it a tech giant? Is it a growth company? At almost $1 trillion market cap, can it somehow be both? If so, what exactly do these rising interest rates mean for Tesla as a result? The overall market is rightfully confused on Tesla right now, so its share price looks like a literal roller coaster. This is why it's so important to know what you hold in the first place, so you're not getting bogged down by things that affect the stock market as a whole, like rising interest rates.
I think that the larger problem that we have in the markets is that there's a tremendous amount of uncertainty being created right now by Washington. We've had tremendous uncertainty over spending, over taxes, over interest rates. And the conversations that I'm having with friends who are investors in really every asset class, real estate, VC, crypto, the conversations are all the same. What's interest rates going to do? What's the macro picture going to be? I've never seen investors who should be focused on, hey, do I invest in this company or buy this building or whatever? Those aren't the conversations. It's all, everyone's a macroeconomist now. And so we're also distracted by this.
Here's my honest advice. If you don't like roller coasters, don't get on the ride. There's no shame in staying on the sidelines until you understand a company and you're confident that you want to hold its stock. You also don't have to put all of your money into these very volatile stocks if that's not for you. And if it is for you, you can still choose to average in that money over time instead of getting on the ride all at once. Even though it's not always easy, averaging in is actually the simplest form of good risk management. Diversifying your holdings is another form of good risk management. Here's an example of a little micro portfolio of just 4 holdings: Tesla, Palantir, the Grayscale Bitcoin Trust, and SPY, which tracks the S&P 500. In just 3 positions, you've got exposure to the bleeding edge of artificial intelligence, energy storage, robotics, enterprise software in a wide variety of markets, and a cryptocurrency that more and more institutions are starting to put on their balance sheets. Then you can use the S&P 500 as a hedge and lower the volatility of this little portfolio, all while getting in some very reasonable returns. If you've been keeping up with my portfolio project, you're seeing me do this exact same thing, except I'm holding Ethereum and Bitcoin instead of the Grayscale Bitcoin Trust, and I'm holding Google and Facebook instead of the entire S&P 500. The less confident you are in picking individual stocks like Tesla and Palantir, the more you can consider putting into SPY until you clarify your position on your individual companies. What's that, you say? You have a life with more important things to do than reading investor presentations all day? Yeah, me too. That's where fund managers like Cathie Wood and Matthew Ball come in. I'm not a financial advisor or a professional money manager, but they are. So I could take something like 5 or 10% of my money and put it in ARKK, which is Cathie Wood's flagship innovation fund, or Meta, which tracks Matthew Ball's Metaverse Index. By doing that, I've actually diversified the behavior that influences my returns altogether, all without compromising my personal investment philosophy. I know what I hold, and if I don't, I at least understand why these fund managers are holding these things at a high level. Why is that important? Because that's exactly how you get the conviction to hold these things as they drop 10%, 20%, 30% or more in the first place, let alone buy more as they crash. Here's the thing, when the Fed raises interest rates, all growth stocks are affected, regardless of who's managing them. So another way to protect yourself from volatility is to invest in assets that aren't closely correlated to the stock market. I already mentioned one example, which is cryptocurrencies like Ethereum and Bitcoin, or even the Grayscale Bitcoin Trust, which trades like a stock but tracks the price of Bitcoin. Another example would be real estate, which is how YouTubers like Graham Stephan, Meet Kevin, and even Stephen Mark Ryan got their start. They can go for more volatile kinds of growth stocks because they've spread their overall financial risk across different asset classes like real estate and crypto. If I'm right about growth stocks getting more volatile in the near future, I think assets that don't move the same way as them should become more attractive as investments. Well, not everyone can afford a mortgage, and not everyone is comfortable with investing in crypto or interested in buying Pokemon cards. So, how can we invest in assets that aren't correlated to the stock market? I actually spent a lot of time digging into this, and the partner for today's video is a great way to do just that. Masterworks.io is the only platform that lets you invest in physical multi-million-dollar paintings without breaking the bank.
If an asset class is uncorrelated with another asset class, that simply means that they behave differently.
Before I found Masterworks, I thought investing in art was only for the super wealthy, but I was wrong. I like Masterworks because according to a recent report by Citibank, fine art had the lowest correlation to the stock market of any major asset class, and that's exactly what we're looking for as interest rates rise and growth stocks continue to fall. Also, according to Citi, contemporary art pieces have almost tripled the S&P 500's total return from 1995 all the way to 2020. That's why billionaire art collectors allocate between 10 and 30% of their overall portfolios to art. That's way more than you thought, right? The other thing I really like about Masterworks is that they're really focused on the investment, not just the art. Their team of analysts use proprietary data to identify artists whose work would produce the best risk-adjusted returns. Then, they acquire paintings by these artists, file the artwork with the SEC, and securitize it, meaning regular people like us can buy shares of the artwork just the same way as if it was a company. These aren't no-name artists drawing animals on digital coins. In 2020, investors saw a 32% net return on Masterworks' sale of Banksy's Mona Lisa. That's 2 times better than the S&P 500. They've also just got a brand new painting by Pablo Picasso. Masterworks.io is disrupting one of the most exclusive asset classes in history by giving everyone frictionless access to artists like Banksy and Picasso, instead of just the ultra-wealthy. That's why I partnered with them. I think the reason Masterworks has such a long waitlist is that they've made something that used to be impossible so easy. You just go to masterworks.io, create an account, browse their artwork, and you can instantly diversify your portfolio with one of the oldest and most stable assets around. So I reached out to them, and they're giving you VIP access to their latest offerings, including that new Picasso painting. I'll leave a link to that exclusive offer for you in the description below. Great. We've covered the Fed working towards raising interest rates, the effect those interest rates will have on growth stocks, the potential increase in volatility of those growth stocks, and ways to manage our risk accordingly, both inside our portfolio and out. Now let's bring it all together and talk about specific stocks. This Goldman Sachs forecast is really changing my 5-year outlook on growth stocks. If Goldman Sachs is right, the stock market is really only pricing in about half the pain that it should be from the future changes in interest rates. This is where all the research that went into this episode comes together. There are 2 specific types of stocks that I think are becoming much more attractive right now, neither of which should be too surprising. The first kind is the mega cap tech companies we all know and love today, specifically Google and Microsoft. In addition to being big innovators in many different markets with many diversified income streams, these companies all have high amounts of stable free cash flow and large cash reserves on their balance sheets, so they don't really ever need to borrow much money to grow. Here's what makes these 2 companies special among the other tech giants like Facebook and Amazon, as well as Nvidia and Tesla. They're much lower volatility. A beta of 1 would mean a stock is just as volatile as the S&P 500 over the last 3 years. Microsoft has a beta of 0.87, meaning it's even less volatile than the overall market. Google has a beta of just 1.07, so its price is also very stable. This is kind of a catch-22 because Google and Microsoft are big parts of the S&P 500, so they're defining the beta for the market. But if you're already investing in the market, you might as well pick the technology innovators that are driving its baseline performance, not just how we measure its risk. Just for reference, Tesla has a beta of 2.03, so it's way more volatile than the market on average. Both Nvidia and Facebook have a beta of roughly 1.3, which is much lower than Tesla, but still way higher than Google's or Microsoft's. This is why Google and Microsoft stand out from the rest, at least to me. Google and Facebook are already in my portfolio, so I'm thinking about adding Microsoft as well. Microsoft is currently the 3rd biggest position in the Roundhill Ball Metaverse ETF, so it's also a great Metaverse pick. The other kinds of stocks that I think are going to be great are the ones that are being mistaken for fintech stocks, but they're not. For example, C Limited has 3 business units: Garena, their online game development and publishing arm, Shopee, which is their big e-commerce marketplace, and C Money, which is their digital wallet and payment solution. It's easy to look at C Limited, say 2 of their 3 business units are getting hit by these interest rates, and write them off as a fintech company. Even though Shopee and C Money are quickly growing and exciting to follow, all of C Limited's actual operating income comes from Garena, which is digital entertainment. Look, I'm not saying that this $100 billion company, which is headquartered in Singapore and makes most of its money through gaming, shouldn't be affected by these rising interest rates. I'm just saying that maybe it shouldn't be as affected as PayPal and Square have been. This is kind of like mistaking Tesla for an insurance company because Tesla insurance is a thing. I would start a position in C Limited, except it's already my #1 holding by a very large amount. So I'm watching out for more companies that the market appears to be mistaking for small cap fintech companies when in reality they're something else entirely. I'll keep you posted if I find any more. They'll probably be e-commerce companies or something related to that area. So there you have it. Comment below or tweet me at tickersymbolu with your thoughts on inflation, on volatility, and on risk. Are you worried about the future of some of your favorite companies? How far out are you thinking? Do you often think about your overall portfolio, including assets outside of the stock market, or are you just looking for new stocks now that interest rates are going to change? I read all my comments and tweets, and I'm excited to hear your thoughts. And if you want to be updated as soon as I make an investment decision, instead of waiting for me to make a video about it, consider joining my highest tier patrons on Patreon or channel members right here on YouTube. Those supporters are getting a lot of extra content each week as growth stocks keep trending downwards. If seeing me lose a ton of money every day isn't really your thing, no worries, I totally get it. I talk about my portfolio and its holdings here pretty often, whether they go up or down.
And it's gone.
Either way, I hope this episode helped you understand what's going on with the Federal Reserve, what their updated policy means for growth stocks, and gave you some ideas on how to manage your risk inside your portfolio as well as outside of it. So, stay long, stay strong, and thanks for watching. Until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.